So this problem here is about a Benjamin Moore paint company, and again we're looking at a variety of ways to look at the profitability of this company's two product lines, selling to paint stores and directly to consumers. So the first one, again, the return on investment. We went through the formula in the previous problem. So return on investment, operating income divided by your assets. So you can see here it's 35% for the paint stores and 11.25 for consumer. So here you have the paint stores, even though they both have a positive return on investment, the paint store certainly far exceeds the return on investment achieved by the consumer division. So we want to delve into this a little bit further to see if we can figure out why the return on investment is so much higher for the paint division versus consumer. So again, profit margin is simply your operating income divided by sales. So that would be $12.50 for paint and 15% for consumers. So in effect, what that's saying is for the paint stores division, they're earning like 12.5 cents on each dollar of sales, whereas the consumer division is earning 15 cents on each dollar of sales. So that's how you would interpret that result. So remember, as an accountant, you're always going to do more than just do the calculations. You have to interpret what that actually means. So requirement 3 is asking us to calculate each division's asset turnover and interpret your results. So the asset turnover, again, is the formula you're going to have to memorize. So it's sales divided by total assets. So we can see here the asset turnover for paint is $2.80, whereas the asset turnover rate is 75 cents for consumers. So what that's telling you is that the paint stores are generating $2.80 for every dollar of assets invested in that division. And compare that to the consumer division, where they're only earning 75 cents for every dollar of assets invested. So as accountants, you have to do more than just calculate these numbers and the formulas. You have to interpret what the information is telling you. Requirement 4, again, we're going to look at another way to calculate the ROI, or return on investment, which is the expanded formula. So for the expanded formula, it's profit margin times asset turnover. So we've already calculated the profit margin, the asset turnover. You multiply them out, and that will give you your return on investment. So the return on investment is the same regardless of which formula you use, the one in requirement 1 or this approach. The advantage with this approach is it's giving you a bit more information. So it's telling you why they're getting such a great return on investment, because although the profit margin for the paint stores is lower than for consumers, their efficiency in asset turnover is much greater. So that's why you have the result that you do here with the 35% return on investments for paint versus consumer. So consumer division, yes, you're certainly getting a higher profit margin, but your asset turnover is much lower. So when you're presenting this information to senior management in the company, they can then see what they might need to do to improve on the return on investment. So for the consumer division, if they could get this number up higher, their asset turnover, then of course that would give them a better return on investment. Requirement 5. So requirement 5 is asking us to calculate the residual income. So the residual income is again a formula that you're going to have to memorize, and it's the operating income minus the minimum acceptable income. So the minimum acceptable income is whatever the company defines it to be. So in this particular example, it's the target rate of return on your total assets. So they've identified they want a target rate of return of 20% on their assets that they've invested in the company. So for the paint stores, their operating income was $490,000, less their target rate of $280,000. So the residual income, in other words, the additional income over and above what they are required to earn is $210,000. On the other hand, the consumer division, they are showing here a negative residual income. So they're making money. They had an operating income of $180,000, but the problem is the target rate of return that the company wanted the division to have is $320,000. So that leaves a shortfall or a negative residual of $140,000. So they didn't meet the target. Requirement 6 is to calculate the economic value added for each division. So your economic value added is defined as your after-tax operating income less the difference between total assets minus current liabilities times your weighted average cost of capital. So your after-tax operating income, you're going to take your income less your after-tax rate. So you have a tax rate you're given of 32%. Therefore, after-tax rate is going to be the difference between the 32 and 100, so it's going to be 68%. So what this is telling you is that you can retain 68% of your income because the rest you're paying in taxes. So that will give you $333,200, and then you're going to take the difference between your total assets as current liabilities times your 15%, and that's the weighted average cost of capital. And again, you would be given that information as to what the company's weighted average cost of capital is. So here we can see that the economic value added for the paint division is $175,000. But for the consumer division, it's actually a negative economic value added. So they're just not creating the level of income. They are making money. Their income is $180,000, and after taxes, it's coming out to be $122,400. The problem is what the company expects to earn is $150,000. So there's a shortfall here of $27,600. So while a company can be making money and making a profit, if it doesn't meet the target that the company wants to achieve, that is not demonstrating economic value added for the company. So for the remaining sections of this problem, sections 7, 8, 9, 10, and 11, all of these I'm going to leave for you to read on your own, but I do want to stress that you are responsible for the material, and it could certainly be a component on your exam. So this type of analysis in terms of these sections could be something that you would be expected to provide in a response on an exam. So that concludes 11-42.